For months, housing affordability in the United States has hit all-time lows, leaving many wondering about the possibility of a crash. Last year, the market showed signs of relief after a period of growth, leading some to believe it marked the beginning of a long housing bear market. However, as the year progressed, the market turned around, with some cities experiencing a return to bubble territory. Now, as we enter June, the focus shifts to whether history will repeat itself and how far prices might dip. One city, in particular, has captured the attention of experts due to its unprecedented price decline: Austin, Texas. Austin's unexpected crash. Unlike other markets, Austin managed to weather the 2008 financial crisis relatively unscathed, with prices remaining flat from 2007 to 2011. However, the city is now in the midst of a massive correction. According to data shared by Lance Lambert on Twitter, Austin's current price decline is outpacing the 2008 crash. In just 9 months, prices have fallen by 10%, raising eyebrows despite the fact that they remain over 40% higher than pre-2020 levels. While a 10% decline may not seem substantial, it becomes significant when considering the low supply and the absence of factors that led to the 2008 crash. At the current pace, Austin could surpass the losses seen in 2008 by next summer, leaving experts puzzled about the weakening relationship between supply and demand in the housing market. The curious case of inventory and prices. Traditionally, the relationship between housing inventory and prices has been consistent. An increase in inventory leads to price decreases, while tight inventory causes prices to rise. However, recent trends have defied this logic. Despite historically low inventory, prices have declined month after month, deviating from the usual pattern. The chart by Bill McBride shows the changing relationship between supply levels and price changes. While we are slowly returning to the norm, the dots representing recent trends indicate a shift in the traditional understanding of this relationship. Speculation suggests that interest rate hikes, affordability issues, and shifting market psychology are all contributing factors to this anomaly. The investor factor. Another factor influencing the housing market is the presence of investors. With investors purchasing 1 out of every 10 homes, their behavior has a significant impact on prices. Investors operate with a different mindset than regular buyers, being more sensitive to price declines due to leveraging and their aversion to being left holding depreciating assets. Large-scale investors, such as Open Door, who operate as iBuyers, rely on loans to fund their cash purchases. As interest rates rise, the potential for losses increases, leading investors to quickly cut prices and exit the market. This behavior can have a ripple effect, affecting entire neighborhoods and causing rapid fluctuations in prices. The uncertain future. As we approach the winter months, the true test for the housing market lies ahead. If history repeats itself, we should see a significant decline in median prices, similar to last year. Experts are closely monitoring the possibility of a recession, as it could impact the housing market in 2024. If the predictions hold true, it is unlikely that we will witness another spring rally like the one in 2023. The potential exodus of investors could trigger a downward spiral, as witnessed in cities like Austin. The winter slowdown and the repercussions of a recession will undoubtedly shape the housing market's future. Conclusion. The housing market's unpredictability leaves us questioning the likelihood of another crash. Austin's unprecedented price decline raises concerns, while the changing relationship between inventory and prices challenges conventional wisdom. The presence of investors adds another layer of complexity to the market dynamics. As we progress into the